protecting yourself from yourself can help with overall investment goals in the future. And the reason why this is so important is because basically today I'm going to show you how our brains work when it comes to making those highly emotional decisions. But what does our emotions have to do with investments? And what is the makeup of our brain and why does that matter? And this is exactly why on this slide, this is exactly why it matters. That 3.6%. This is how much the average investor underperformed just the indexes over any 10-year period of time. And that number is actually really huge, specifically if you extrapolate it over, let's say, 10 or 20 years of investing or retirement. If an average investor started with $100,000, that translates to making $65,561 less than the market returns. And underperformance of this size, in our opinion, can be prevented. So let's first get into kind of the functions of the human brain. And a big reason why we don't reach our full investment potential has to do with how the human brain is wired. So even some neurologists believe that we have not one, but 3 brains, and that each of these 3 brains represents a different part of the evolutionary process in general of human beings. And the area of the brain that includes the brain stem is considered the reptilian brain. And the reason why is because it exhibits the same types of behaviors as snakes and lizard brains do. It controls muscles, balance, and automatic functions like your breathing and your heartbeat, and it keeps repeating the same behaviors over and over again automatically. That's where the stem of the brain is. The center part of the brain, which is the mammalian brain, is similar to the brains of most animals. It focuses on emotions and instincts. If you think about it, when we feel scared or threatened, we react in a similar way to an animal. Our instincts kick in and we tend to react without much thought really behind it. It's more of a visual response to fear, that fight or flee mentality. And then that brings us to the more recently developed, at least in history, portion of the brain, which is the human brain. And this is what makes us human beings so superior to every other living creature on the earth. It's considered the CEO of the brain, and it's responsible for adaptive learning, rational thought, and it's what separates us from basically the animal kingdom. It's reflective, it's slower and deliberately controlled. It regulates emotions and considers consequences of action. So when you start thinking of how these different areas of the brain really dictate your overall emotional behavior and investment behavior, you can see that if one portion of the brain starts to kick in over other portions of the brain, it could lead to poor investment decisions over a period of time. So the thing is that sometimes the mammal brain takes over when emotions run high. It houses that part of the brain called the amygdala. And in these times, the amygdala can hijack or override our logic and reasoning, leading us to actions and decisions we may later regret. So I'm sure no one that's listening today has done something they regret, right? But gut reactions are a very real and automatic thing. So there's psychological evidence that the amygdala goes into what we call code red mode or senses danger. It actually drains blood from the brain and sends it to our muscles to do something about it. And think about how your body reacts when it's startled in the night or if you're physically threatened. That's your amygdala in action right there. So if we talk about that code red, if your child jumped into a pool as an example, and it seemed like they were in trouble, it would be your animal instinct to jump in after them right away. Even if you had your clothes on, your phone in your pocket, you would jump right in. When we feel threatened, protective, or even in danger, our emotions take over, and oftentimes we can't help but just simply react just at the snap of a finger. Now, when you really think about it, money in general, earning enough of it, the possibility of losing it, is emotional. Sometimes even highly so, right? In our world, the world that we all live in, we need money to a certain extent to survive. Without it, it'd be hard to, have enough food to eat or a house to live in. it would even be difficult to create opportunities that we want for our kids and our children. But research suggests that our gut feeling or our gut feelings are our default decision-making process. And these gut feelings are heavily influenced by emotions and biases that sometimes override logic and lead to poor decisions, especially in the area of overall investing. And in these times of high emotions, like what we're going through specifically in this year in 2020, we might be better served with the area of the brain that controls the logic and the reasoning and not the emotions and gut reactions. Now, I'm not saying that all gut reactions are negative. You know, my grandmother has been living by her gut feelings her entire life, and she always tells that to me. So I'm not putting them down. It can sometimes cause confusion when it comes to making investment decisions. So today what we'll do, and this kind of talks about a little bit, we'll show you how some common behaviors from behavioral finance can lead to poor decision making despite even you having the best intentions, right? So I'm sure this female in this photo had the best intentions to work out. She seemed prepared. She's got all the right equipment and she's dressed to in her fitness gear, but she happened to turn on Netflix. So despite our best intentions, sometimes we make emotional decisions that don't always play out into our favor. So the first portion of behavioral finance is a theory called overconfidence. And this is really important. So let's start by discussing just the concept of overconfidence. You know, it's great to be confident, but overconfidence is a form of self-deception. And think to yourself, just for a moment, if you would characterize your driving skills as above average. I'll let you think about that for a second. Do you characterize your driving skills as above average? Well, there's a study done by AAA where 73% of people characterized their driving skills as above average. Now, if the group was well calibrated in assessing their own skills relative to others, we would find an outcome of about 1/3 below average, 1/3 average, and 1/3 above average. But the tendency to overestimate our skills extends to many different areas, especially where they're perceived pride and ego. So another example, the more information you have, the more false confident you become. So in 1973, there was a study with 8 experienced bookmakers, okay? And those bookmakers for betting were given data on 40 past races and asked to rank the top 5 horses in each race. So data was given in increments of 5, 10, 20, and 40 bits of information that they had selected in terms of importance. And the more data they received, the more their confidence continued to rise, but their accuracy, as you can see here, actually fell with more data. So think back to when, you know, your parents, or at least my parents, or even when you had smaller children, parents learned from books or from family members, which meant only the best, right? Most curated advice was passed down. Now today, if you need some child rearing advice, there are millions of resources at the click of a button, which means there could be a whole lot of bad information mixed in with the good stuff. So this gets that concept of less versus more. And on our first podcast with Whalen, we kind of talked about this, about the industry in general, with this infinite amount of data that is being pumped into not only individual investors, but also in the industry itself. So when you think about the sheer amount of information that we're exposed to, you know, every single day, we must think where, you know, we have to believe to some extent that we're know-it-alls with all this access to information. You know, each day, humans themselves create about 2.5 quintillion bytes of data every single day. And it's estimated that there are over 3 billion Google searches every single day. And with the power of the internet behind us, it's easy to think that you're an expert in just about absolutely anything. And the same is true with investors. Today's investors have more access to data points than ever before. Years ago, the most astute investors probably had access to, let's just say, the Wall Street Journal as an example, and that was about it. And the more data increases confidence, but it doesn't always increase accuracy, as we talked about with those bookmakers on those horse races. So selecting the right stocks in an extremely difficult task, and it's a type of task that people exhibit with the greatest amount of overconfidence. So the next concept, past confidence, overconfidence, is what we call the aversion to loss. And this is really interesting, and it gets back to that point of, the pain of a loss is 2 times greater than that of a perceived gain. So if overconfidence is simple and straightforward, then aversion to loss is a little bit more tricky, because it has to do with how we perceive and experience risk. So here's a classic example. Let's consider 2 gain choices and 2 loss choices, as you can see on the screen. So the first choice is you will get $500 in a gain, or you have a 50% chance of nothing happening and a 50% chance of getting $1,000. The second scenario is you will lose $500, or you have a 50% chance of losing $1,000 and a 50% chance of nothing happening. So this tells us that people are risk adverse when faced with positive outcomes, but are risk seeking when faced with negative outcomes. Why? Because investors feel the pain of a loss, like I said, 2 to 3 times more than they feel the euphoria of a gain. So several small gains are preferable to one big gain, and one big loss is preferable to many small losses. According to the study at Econometrics that was done in 1979, and this was known as what's called the prospect theory of aversion to loss. So let's say you're interviewing for a big job, just as an example, an important job, but the truth is you don't really want it. You know it'll be too stressful, keep you away from spending quality time with your family, yet you give it all because the prospect of losing it to someone else is greater than what you'd actually gain from the job, right? More pressure, more headaches, more hours in the office. This is aversion to loss. Aversion to loss is why people keep large amounts of cash in their portfolio. And it's not always a terrible idea. Sometimes there's specific purposes why some of our clients would keep a larger than normal allocation towards cash, a specific upcoming purchase or a need for that money in a short period of time. But when you have cash in your portfolio, it will not go down. That's the perceived thought. But it won't really go up either, specifically with how low interest rates are. So saving money in cash or money market funds essentially loses money over time. You can see it here. This just assumes a 3% inflation rate. It may not seem like it, but because your cash account balance probably won't decline, but the buying power of that cash definitively will. Imagine you have, like I show here, $100,000 when you retire, and your retirement is going to be at least 25 years long. If your money isn't growing faster than the assumed 3% inflation rate that we used in this example, the inflation is going to eat away at the purchasing power. So 25 years later, that same $100,000 is only worth $48,000. So you feel that safety net of having that large amount of cash in a portfolio or in a bank account. But what people don't really realize is the loss of those dollars when it dictates to buying power. So I'll use another example of keeping cash on the sideline. So this is the last presidential election here. And I'm sure everyone can relate to at least this example. So no matter where you stood politically, you probably remember the emotional roller coaster leading up to that 2016 presidential election between Hillary Clinton and Donald Trump. Probably another one, coming up in this November. There was a barrage of sensational, media headlines, the likes, to which we've never really seen before, and campaigns run like what we've never seen before. And many people felt uncertain about the future. So what this timeline shows is in October, the month before the election, about $24 billion was withdrawn from the equity markets. We don't know, we don't know for sure, but we can assume that it went into cash or fixed income type investments, which people view as safer and less prone to risk. Then the election happened in November, and the financial markets returned 3.7% in that month. That was the largest monthly return in an already really strong year of 2016. So guess what happened right after that? All the investors who were scared of losing money missed out on the returns. They didn't want to lose out on more, and their fear of loss went away. So in December, almost the exact same amount that was withdrawn in October was reinvested in December. Nearly $24 billion was poured back into the equity markets. So it's interesting why the fear of loss can actually dictate the investment behavior of at least an individual investor. The next one, which is probably the most prominent of behavioral finance study, is what we call anchoring. And anchoring is essentially the behavior that influences how we make a large amount of our decision. And the term anchor refers to our tendency to hold on to what we're comfortable with. We allow it to influence our decisions, even though it may not be related to the decisions we're trying to make. And the anchor becomes the starting point, and we tend to make adjustments around that anchor. So in one experiment at Columbia University, the business graduate students were asked to write down the last 4 digits of their telephone numbers and then write down how many doctors they thought worked in Manhattan. Well, the group was then subdivided into 2 groups after they did that. Those with telephone numbers ending in 0000 to 2999, which is the low numbers, and those with numbers ending in 7000 and 9999, or the high numbers. So the average guess for the group with the low telephone numbers was 16,000 roughly, while the average guess for the high telephone number groups was 29,000, higher by about 75%. So if someone had a low number in their head, they subconsciously made a lower estimate on the number of doctors, and a higher number led to a higher estimate. So the 2 tasks obviously had nothing to do with one another, but the act of linking them together influenced the outcome on a subconscious level, which is known as anchoring. So anchors can be embedded in our brains just in general, and we're not consciously aware of them, but they can influence how we'll react to just a given situation. So let's look at these 2 identical houses here. They're side by side, they're in the same neighborhood, both listed with the same agent at the same time for $1 million. Both sellers are equally motivated to sell. A buyer, indifferent to which one they buy, puts a bid in for both for $900,000. The question is how will seller A react to the bid versus seller B? What anchors could be at work here, right? Now consider seller A bought the house 15 years ago for $300,000, and seller B bought the house 2 years ago at the top of the market for 1.2. Who is more likely to accept that bid, right? Clearly, seller A would be. And the common response is like I said, seller A. And the reason is because of those pre-existing anchors that may be involved in making those investment decisions. Another way to look at it is emerging markets. So if you look at that map that's on the screen, 50% of the world's population lives in that's highlighted circle area on the right-hand side. And anchoring happens in investing all the time because we make investment decisions based on our familiar associations, right? Take emerging markets, like I just said. The emerging market economies are not as developed as the US, and they often have lower per capita income. Examples of emerging market countries would be India, Peru, Chile. People in the United States, though, hesitate when it comes to investing in emerging markets, or at least companies that have exposure into those emerging market areas, because they're not as familiar with them as US markets. Or it doesn't seem that they could provide the type of returns a more established country might. The US provides a frame of reference, there's an anchor. But in reality, the growth potential of emerging markets is actually kind of staggering, or at least having companies, even if they're US based, with exposure into emerging markets. Over 50% of the world's population, like it shows on this screen, lives in that area. And emerging markets make up about 40% of the global economy. And that's doubled in the past 25 years. So today, emerging markets are the largest economy in the world, bigger than the US, bigger than Japan, bigger than all of Europe. The size of their middle class is now bigger than the US middle class. Yet they feel very unfamiliar to a lot of people, so they generally make up a small portion of investment portfolios, somewhere between 0 to 5%. But knowing and investing in that way is known as a form of anchoring. Something that hits a little bit more home, this is one of my favorite theories, just because we are located primarily in Las Vegas, so we can kind of relate to betting just in general, but it's called pattern-seeking behavior. And this is where we kind of see if we have individual prospects come in and we do portfolio reviews where where they really do exhibit this pattern-seeking behavior. And sometimes it can be hard to break that pattern. And this is just another form of bias that people tend to have, that pattern-seeking behavior. If we put it simply, the human brain seeks patterns, even when there's nothing there. It's just how our brains are wired. So if we take an example that many of us are familiar with, the casino game roulette, the common understanding is that you place your money on red, black, odd, or even, and you have a 50-50 shot at winning. That's a perception. For years, the casinos made their money on the fact that the two green numbers, which is 0 and 00, tilted the odds in the favor of the casino to better than 50-50. But the casinos really started making a lot of money when they installed the number boards featuring the results of the last 10 to 15 rolls. So we've all been walked through a casino, or the majority of us probably have. And next to the roulette table, they have those screens that show the results of the last 10 or 15 rolls. That's when they really started making a lot of money on roulette. Many casino patrons, stroll by, look at the board, and feel like there were too many reds in a row, and now it's black's turn. Well, they place a substantial money on the spin, not realizing that the odds themselves of getting a red were the same every single time, regardless of the previous outcome. So if you look at it conversely, some people decide to play the hot hand, right, and place a large sum of money on black, thinking the odds somehow favor it. So this is a prime example of what we call pattern-seeking behavior. And it's really a folly of it. And if we look at an example of pattern-seeking behavior that investors have exhibited over the last 5 years, let's take a look at this. So one common area where investors have exhibited pattern-seeking behavior is in the search to predict the moves of the bond market. So let's try to predict this together, right? So from the 70s to the 80s, interest rates had climbed on bonds from 7% to over 15%. In 1981, interest rates peaked at about 15.8%. After they peaked, they started to fall. In the next 10 years, they went from 15 to roughly 8%. They predicted to go up at that point, but the problem was they kept going down and down. They never went back up for almost 40 years. The pattern didn't play out as it was expected to. So if you look at it by the decades, the quote unquote pattern that actually happened was up, down, 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 down. And we've experienced an unprecedented period of decreasing interest rates. And it's been relatively easy to make money in bonds for the last 4 decades because when interest rates go down, bond prices tend to go up. The problem is that not everyone experienced this easy money because they were so busy predicting a pattern that wasn't there. So investors who kept predicting that rates would go up mismanaged their fixed income investments and underperformed the market. You can see the bond market over a 20-year period of time has averaged about 4.6, but the average fixed income investor has only averaged 0.44, not even close enough to keeping up with inflation. And it's because of that want or that feel or that desire that they would have some form of pattern that they could follow that trend. Here's a really interesting one. It's called representativeness. And behavioral finance really looks at this closely, and they kind of link it to anchoring. So let's consider this information. What if I told you these characteristics and facts about Susan? So number one, she's quiet. She's scholarly. She's passionate about social issues. She graduated from Stanford with a focus in English Lit and environmental studies. So of these 3 positions, which one is most probable? Is Susan going to be a librarian? Is Susan a librarian with a member and a member of an environmental organization? Or does Susan work in the banking industry? So in research settings, 1/3 of subjects choose A. 2/3 of subjects choose B, which leaves 1% for the correct answer, which is actually C. Susan works in the banking industry. And you're probably saying, Andrew, how do you gather that information? You said she was quiet, scholarly, passionate about social issues, went to Stanford with a focus of English Lit and environmental studies. B seems to be the perfect answer based off the information that you were giving us. But remember, the question involves probabilities. There are nearly 2 million people who work in banking and less than 200,000 who work as librarians. So in any given situation, doesn't matter what it is, someone is 10 times as likely to be in the banking industry versus the librarian profession. And the odds that he or she are both a librarian and a member of an environmental organization are statistically remote, right? So we're talking about probabilities. But 2/3 of responders pick B. So another way to think of this is, let's talk about representativeness, or how focusing on a narrow set of information without considering all the facts can hurt investors. So many stocks issue dividends, which are a good investment strategy for investors who need additional income. But what if I told you one of these stocks was a company that was founded in 1892 and has successfully been in business for over 120 years? And that company has been so successful, they operate globally with over 250,000 employees and have businesses in healthcare, aerospace, energy, and digital tech. And that this company has basically been a household name for multiple generations, and it's pretty likely you've even used one of their products in your home. So how many of you, taking that information, would want that stock in your portfolio to produce income, dividends? Based off of that information, there's probably a good number of people that said, yeah, absolutely. It sounds like a really stable, good option for dividends. But then what if we expanded our lens, which is what stocks do, right? Stocks are basically telescopes, and when they expand their lens, you get more information. And we looked at a little bit more of the facts. What if I told you the CEO of the company recently came out announcing a new corporate strategy with a significant amount of reorganization, selling off business units, and laying off thousands of employees? And that because the company was so short on cash with so much debt that they recently had to slash their dividend in half and lost over $7 billion in 2017. And that because of these problems, their 111-year run in the Dow Jones Industrial Index recently came to an end when they were removed. With that bigger picture view, would you be so quickly to rely on that stock for regular dividend income checks? And that's just a form of representativeness. Here's another one. Municipal bonds are a type of tax-free fixed income investment, and they're issued by states and cities to fund public projects. And what if I told you there was a municipal bond for a public school that was located in one of the most poverty-stricken and violent areas of Chicago, where over 80% of the children were in free lunch programs, and over 1/4 of the children are considered homeless without a permanent address of record? How many of you would be leery of investing in that municipal bond? And I would assume there would probably be a good number of you. But unfortunately, a poor public school doesn't really sound like a great investment all the time, right? But then what if we expanded the lens again and looked at all the surrounding facts? Because it's in one of the poorest areas, this school is supported by the federal grant money, which almost guarantees that the bond will not default. It makes it a safer investment. Also, this school is part of an innovative new charter program that increased its graduation rate to almost 100% in the last 5 years and increased the percentage of students that go to college by over 70%. And because most investors like you are leery of it, the bond is actually offering a really great yield relative to its price, kicking off some good income for you as an investor. With that bigger picture view, would you change your mind on investing in that municipal bond? So those are 3 examples of representativeness, and it's very closely tied to overall anchoring. But one of the closer to the final ones is recency bias, and we see this probably more than absolutely anything else. And this basically breaks down, the tendency for people to focus on what happened most recently. Oh man, 08 is right around the corner again. There's going to be another big drop. There has to be, another huge uptick or a spike in COVID, which is going to cause an even further correction than what we saw just a few months ago. Or the NASDAQ is just like the tech bubble of 2001. Think about, just as an example, to not talk about investments, but let's think about like an employee performance reviews, which we've probably all experienced at, some point in our lives. The tendency of the reviewer is to remember the employee's performance from the past several weeks or months. The employee then may have had a huge triumph or win 4 months ago, but maybe had a slip up 1 month ago. It's not far-fetched in that example to think, my company's deciding on bonuses next month, better be on time. Because we all pretty much know that it's more likely for the reviewer to focus on a slip up rather than a job well done. So let's look at this. It goes back to the financial crisis. So for investors, the 2008 financial crisis offers a really, really good example that I hope you can all take this away. After that happened, the Fed and the global central banks put a heroic monetary policy measure together and put it in place to kind of recharge the economy. They kept interest rates low to encourage people to spend money. And as a result, investors had great returns in the decades after the financial crisis. And in fact, it has been one of the longest and strongest bull markets in history up until March of this year. The issue is that investors were too focused on their recent experience in '08 to benefit from it. And in fact, in all but 2 years since the financial crisis, investors have taken money out of the market and missed out on great returns. You can see that here. You can see the net inflows on the bottom each year, which are all basically in red except for 2013 and 2014, meaning individual investors actually pulled money out of the market during that time versus doing the opposite, which is actually keeping the money invested. So that's what we call recency bias. And that's a really big hurdle as financial advisors and as wealth managers to really be that financial therapist for our clients to kind of bring them back into, hey, maybe not everything is the worst case scenario, because if we can keep their money invested, it has a higher probability of producing greater returns over a specific period of time. And then that leads me to vacation syndrome. So at any time there's a blip of volatility, the media goes crazy and investors start to get nervous. But what people have to understand is that volatility is normal. And I know it's easier to say that than to hear that, but it is absolutely normal. And we often call this the vacation syndrome. They say when you go on vacation, it takes 2 to 3 days to settle into vacation mode. Then after the 2 or 3 days, you sleep in, you go out to eat, and by the time the trip is over, you think it's normal to take a cat nap in the cabana by noon, right? Then the vacation is over. You go back to work. You take care of your kids. You clean the house. These are all really normal things to do, but now they feel so much harder because you got used to vacation mode. The same thing happens to investors. So 2017 was the least volatile year in the last quarter of a century. Anything after that may be totally normal, but it feels, well, harder. So what does that mean for your portfolio? Well, let me show you this. Would you be happy that you purchase a stock if the performance looked like this? I would say most people would say yes. This is that same stock. The yellow segment of the chart is the portion that was represented previously, but the expanded chart area includes a longer time period. Are you still happy with that stock performance? And this is, one psychologist representation of the investment cycle. It's from the investment philosophy cycle that was, published in 2010. And it kind of explains the roller coaster of investor psychology in general. And it may reveal one of the single biggest reasons that investors tend to capture only a fraction of the returns in the underlying asset classes that they tend to invest in. Investors rarely ride out the entire market cycle. And that is one of our biggest jobs here at Whalen Financial, to ensure that you stay on the track. When they start to experience fear or panic, they tend to get out. On average, investors commit to an equity product or equity portfolio for just under 4 years. Only 4 years. And a fixed income portfolio for just over 3 years. So I don't know if you've ever read an investment book or an article online But there is a saying that says investing's for the long term. But statistics show us that the average person who invests in an equity portfolio is only in it for 4 years. And the problem is they buy and sell at the wrong times. They buy when they're at a peak of the investment psychology cycle, and then they think the markets are good, they're feeling great about the returns, and then they decide to reinvest more. But this is actually one of the most expensive times to invest your money. The opposite is also true, though. They sell when they're nearing the bottom of a cycle. Things may feel scary to them, or they're in a panic because something big has happened. But the problem is that they're looking, or what they're doing is they're locking in those returns and won't be invested when things start to pick back up again. And here's why. Out of anything that I do, trying to control investor psychology is probably one of the biggest roles that we have to play, other than portfolio selection. And because if I can keep you invested, what this chart shows is that the biggest gains are generally early in a bull market. So right now we're at least in the S&P 500, we're still in a bear market. We are in a recession right now. The next phase would be inevitably a bull market whenever that does occur. And what this chart shows is the problem with not being invested when the cycle starts back up again is that the first third of a bull market is typically the most dramatic in terms of return. But many investors don't capture the returns during this phase because they're on the sidelines. And it's easy to see how missing the first stage of a bull market can greatly reduce your returns over a full investment cycle. So you can see 25%, the first third, 12%, the second third, and then 13%, a little bit higher because people are trying to catch up. But staying invested is one of the most important pieces of advice because of the statistics that look at, the early bull market returns versus the later portions of a bull market. And we touched on this in the beginning, but what it all comes down to is these behaviors, whether that's recency bias, anchoring, pattern-seeking behavior, which are all components of behavioral finance, cause investors to make poorly timed decisions and generally underperform the market. And here are some of the results. So the market return, and this goes back, it averages 10-year periods of time, for the S&P 500 has been about 8.5%. However, the average investor has only averaged about 4.88. Fixed income is basically the same, 3.31 versus only just under 0.5%. So these biases can be, not fully eradicated because we are humans, but we are able to make rational decisions when emotions run high. We have to believe in that thesis because I don't think we're destined to use less intelligent parts of our brain when it comes to our money. And there's, the positive news is that there's ways to counterbalance our emotions essentially. And we can overcome biases and mental shortcuts. And that's the role of a great wealth advisor. And it should not at all be underestimated. And I think the industry, or the race to zero in fees, or the incorporation of technology has really pushed down the important part of what a wealth advisor or a financial advisor or financial professional actually does. So what we did is to kind of summarize today, we wanted to make sure that everyone was aware the 5 key areas where advisors can help us overcome some of these emotional biases and these emotional patterns. First is we try to always focus on the long term. I said it just a little bit ago. And for most of us, long-term goals, aspirations, and objectives are absolutely a big thing. And the further away in the future they are, the easier it is to stray away from what we said we wanted, right? So if retirement's 10 years away versus 5 years away, it's easier to stray away from some of those goals if they're further out in the future. So in some ways, we treat our future selves as we would treat a stranger. And that's where we come in. We try to help you stay focused on what you want to accomplish over those periods of time and try to make adjustments accordingly. The second is, discipline through up and down markets. And I talked about that being a financial therapist, which is a proud part of my job. Rules prevent us from making rash decisions so that we don't regret them a little bit later. And knowing ahead of time what you should do in case of certain situations will help you get through volatile markets and not make those emotional decisions. Number 3 is tax awareness. one of the biggest drags on investment returns is taxes. And it's by far the most consistent attribute of investing. Yet few actual investors take the necessary steps to ease the corrosive effects of taxes when and if it's possible. And as advisors, we have those tools. We can run those illustration models and the knowledge to manage the different portfolios, specifically if it's non-qualified money, non-retirement money, more tax efficiently and help investors keep more of what they earn. And then number 4 is emotional objectivity, which is pretty big. And as we discussed, our emotions, and from what we could read from the presentation, our emotions are very hard to manage just overall in general. And making investment decisions in an emotional state can lead to very bad outcomes. So putting distance is what we like to call it between the investors and their money sometimes can help prevent some of those mistakes that we kind of discussed today. And then lastly is education and guidance. One of our major roles is to teach and guide investors towards achieving, their financial goals. And in terms of overcoming emotions, guidance is by far the most important component. And as we saw in the example of Harry Markowitz himself, education alone is not going to help us overcome biases. When it comes to investing, though, time after time, we've seen that the smartest, most educated people can make these terrible behavioral mistakes. So it's not something that's going to be addressed, obviously overnight. But I'm going to leave everybody here with this. I hope you all enjoyed it. It's just a way for us to, really educate you on ways to really understand how your money works and how you think about your money, how you think about the markets, and how some of these behavioral finance traps can actually alter your investment decisions overall. And I grew up a Warren Buffett fan. One of the first investment books I read was The Intelligent Investor. That was written by Benjamin Graham. He was a professor at Columbia University, and he's known as the father of modern security analysis. And what he says here is the investor's chief problem, and even his worst enemy, is likely to be himself. And I just want to leave that here for you and think about, have you ever made an emotional investment decision, whether it was for the better or for the worse, that you ended up regretting on the back end because of some form of behavioral bias that is just naturally in our brain? And if so, you're not alone. We're here to help any way we can. I really do hope everybody enjoyed today's presentation. Thank you for letting me spend about 30 or 40 minutes with you today. If you have absolutely any questions, please make sure you reach out to us at 702-878-3900. And over the next 2 or 3 weeks, we do have a few more coming up. So July 29th is where we're going to review disruptive technologies and why we're investing in those certain areas of clients' portfolios. Follow that on August 12th, which is our big time halftime report, where we review the first 6 or 7 months of this year and look forward to what we think is going to happen based off of all of the analysts and all the researchers and all the economists that we work so closely with. And that's going to be August 12th. And then finally, one that I'm really excited for, just because I was able to look at the presentation and really go deep into it, is Great Things Happen When You Think Further. That's August 26th, where we're going to hear from some of the smartest minds around the world, where they talk about what they see their industries trending towards and how that's really going to shape the overall world economy as well as the U.S. economy, and give us a little tips and pointers of kind of where we want to be placing client assets over the next 20 years. So thank you so much for taking the time. I really do appreciate it. If we are going to send this out to everybody as well. So if you want to share it with anybody, feel free to. I hope you enjoyed yourself today, and I hope I was able to, at minimum, just inform you on basic behavioral finance traps, and hopefully we can avoid those in the future. Thank you, everybody. Have a great day.